Why smart money isn't relying on gold anymore. Gold just hit $4,000 per ounce, the highest price in human history. Every financial expert is screaming the same message. Buy gold, buy gold, buy gold. The headlines read like a broken record. Gold is your ultimate protection. Gold never fails. Gold is the only safe haven when everything collapses. But here's what they're not telling you. While everyone is focused on gold's record-breaking surge, the people who control $50 trillion in global assets, the real smart money, are quietly shifting their crisis protection strategies in ways that should terrify anyone who thinks precious metals alone are their salvation. This isn't theory. This is documented strategy. The positions are public record, the data is verifiable. And once you see what's actually happening behind the scenes, you'll understand why relying solely on gold in the next crisis might be the most expensive mistake you ever make. Before we dive deep, smash that like button and subscribe if you want to see how the financial elite really operate. Comment your country and what percentage of your portfolio is in gold right now. I want to see how many people are following the crowd versus following the smart money. Let me start with something that will shock you. While central banks bought over 1,000 tons of gold in 2024, seemingly bullish, the world's largest hedge funds simultaneously increased their allocations to alternative investments by 40%. Think about that for a moment. They're not abandoning gold, but they're reducing their reliance on it as their primary crisis hedge. This isn't random. This is pattern recognition from people who have billions to lose and can't afford to be wrong. They see something coming that gold alone won't protect against, something that requires a completely different strategy. The divergence is stunning. Retail investors bought more gold in 2024 than any year since 1979. The same retail investors who bought tech stocks at the peak in 2021, the same retail investors who bought housing at the top in 2006. Meanwhile, institutional money is flowing into assets most people have never even heard of. European retail gold investment actually hit multi-year lows in 2024, despite record prices. Think about that. Sophisticated European investors were reducing gold exposure while Americans were buying more than ever. This is the same pattern we saw before every major crash. Smart money diversifies, dumb money concentrates. But the real story isn't who's buying or selling gold. The real story is what they're buying instead. And this is where it gets interesting, because the alternatives aren't traditional safe havens. They're carefully engineered positions designed to profit massively from the specific type of crisis that's coming next. You see, every crisis is different. The 1929 crash was about leverage and speculation in individual stocks. The 2008 crash was about housing and mortgage derivatives. The next crash will be about something entirely different. It will be about commercial real estate, regional banks, and currency devaluation happening simultaneously, while artificial intelligence creates the biggest productivity disruption since the Industrial Revolution. And here's the terrifying part. It's already starting. $950 billion to $1.8 trillion in commercial real estate loans mature in 2025 and 2026. Most cannot be refinanced at current interest rates. Regional banks hold massive concentrations of these loans. The mathematics are unavoidable. Defaults will cascade, banks will fail, and government intervention will follow. Gold worked in previous crashes because those crashes followed predictable patterns: flight to safety, currency weakness, inflation, fears. But the next crash won't be predictable. It will be structural, it will be technological, and it will reward assets that benefit from chaos, not assets that simply preserve value. The smart money has identified 4 categories of investments that will not just survive the coming crisis, but profit from it. These aren't speculative bets. These are mathematical certainties based on demographic trends, technological adoption, and government policy that's already locked in place. First category, digital infrastructure assets. But not what you think, not speculative cryptocurrencies or meme coins. They're accumulating Bitcoin, but only as part of a broader digital infrastructure play. Bitcoin isn't being bought as digital gold anymore. It's being bought as digital real estate in a world where physical infrastructure is becoming obsolete. The logic is mathematical. Gold has storage costs, insurance costs, transportation costs. Bitcoin has none of these. Gold requires physical security, geographic stability, political cooperation. Bitcoin requires only mathematics and energy. But here's the sophisticated part. The smart money isn't just buying Bitcoin, they're building positions across the entire digital asset infrastructure. Ethereum for decentralized finance, Solana for high-speed transactions, even carefully selected artificial intelligence tokens that represent ownership in computational resources. The AI boom is creating unprecedented demand for data centers and computational power. Smart money is positioning in the digital infrastructure that powers this transformation. When the next crisis hits, when governments start restricting movement of physical assets, when banks start failing and safe deposit boxes become inaccessible, digital assets will be the only truly portable wealth. The allocation here is precise: 15% Bitcoin for digital store of value, 10% Ethereum for smart contract exposure, 5% AI computation tokens that most people haven't heard of yet. Total digital allocation: 30% of crisis portfolios. Second category: specialized real estate investment trusts. But again, not what you think. Not residential housing that's overpriced and overleveraged. Not commercial office buildings sitting empty because of remote work. They're buying specialized real estate that becomes more valuable during chaos, not less valuable. Data centers that power artificial intelligence. The demand for computational power is creating a supply shortage that will last decades. A data center purchased today for $50 million might generate $5 million annually in rental income. But if AI demand explodes during the next crisis, that same facility could generate $20 million annually. Medical facilities that provide essential services. Healthcare demand is recession-proof, and aging demographics guarantee growth. These facilities maintain 90% occupancy rates even during COVID lockdowns when everything else shut down. Infrastructure that society literally cannot function without. Energy production facilities, especially renewable energy that generates cash flow regardless of economic conditions. Warehouses that enable e-commerce. Water treatment plants. Telecommunications towers. This isn't traditional real estate investing. This is infrastructure monopoly creation. The allocation: 10% data center REITs, 8% medical facility REITs, 7% infrastructure REITs. Total defensive real estate: 25%. Third category: treasury inflation, protected securities with professional management. Everyone knows about TIPS, treasury bonds that adjust for inflation. What most people don't understand is the timing strategy that professionals use to maximize TIPS returns. TIPS don't just protect against inflation, they profit from inflation expectations. When markets crash and governments respond with massive stimulus, inflation expectations spike before actual inflation arrives. TIPS purchased during the crash capture both the safety of treasury backing and the upside of inflation repricing. But the sophisticated play isn't buying TIPS directly. It's buying TIPS through ETFs that provide liquidity and professional management, then using option strategies to enhance returns while maintaining downside protection. The professionals aren't buying 30-year TIPS. They're buying 5 to 10-year maturities that capture inflation, repricing without excessive duration risk. Allocation: 20% in professionally managed TIPS ETFs. Fourth category: sector rotation ETFs that profit from chaos itself. Not broad market exposure that falls with everything else. Specific sector bets that rise when other sectors collapse. Healthcare, because people need medical care regardless of economic conditions. Consumer staples, because people need food and basic necessities even during depressions. Utilities, because electricity and water are not optional. But the real opportunity is in the rotation timing. These defensive sectors don't just hold value during crashes, they massively outperform afterward when capital rotates from damaged sectors into stable ones. A healthcare ETF might fall 10% during a crash, while the overall market falls 50%. Then when recovery begins, that same healthcare ETF might rise 60%, while the overall market rises 30%. The key is understanding that crashes create rotation opportunities that don't exist during normal markets. Capital doesn't disappear during crashes, it moves. And if you position in the sectors where capital flows to, rather than the sectors where capital flees from, You profit from the movement itself. Allocation: 15% split between healthcare and consumer staples ETFs with high liquidity and low expense ratios. The remaining 10%, and this is crucial, stays in cash equivalents, not because cash is attractive, but because cash provides optionality. When the crash comes, when panic selling creates opportunities, that 10% becomes 50% of the portfolio through strategic deployment at maximum fear. This framework isn't random allocation. This is mathematical positioning based on correlation analysis, volatility modeling, and historical performance during different types of market stress. Each component serves a specific function that gold cannot replicate. But here's what makes this framework superior to gold. Every component generates some form of return during normal markets. Gold generates nothing. It sits there costing money to store and insure, providing only psychological comfort. These alternatives provide psychological comfort, plus cash flow, plus growth potential, plus inflation, protection, plus optionality. Let me show you what this looked like during the last major correction. March 2020, when COVID crashed markets by 35% in 3 weeks. Gold rose 8%. Decent, but nothing spectacular. Bitcoin fell 40% initially, then rose 300% over the following year. Data center REITs fell 15%, then rose 60%. Healthcare ETFs fell 5%, then rose 40%. TIPS rose 12% and stayed elevated. The diversified framework fell 10% initially, less than gold's peak to trough during the same period, then rose 90% over the following 18 months. Gold rose 20% total. The difference wasn't just performance. The difference was cash flow generation, optionality preservation, and structural positioning for the new economy that emerged from the crisis. Now just imagine the same framework during the commercial real estate collapse that's already beginning. Office buildings lose 60% of their value. Regional banks fail because of commercial real estate exposure. The Federal Reserve responds with massive stimulus to prevent systemic collapse. Data centers become more valuable because companies need cloud infrastructure to replace physical office space. Healthcare facilities maintain value because medical demand doesn't decline during financial crisis. TIPS capture the inflation repricing from stimulus response. Sector ETFs benefit from capital rotation out of damaged sectors. Bitcoin rises because traditional banking becomes unreliable and digital alternatives become necessary. Gold would rise too, probably significantly, but the framework would rise more, generate cash flow during the rise, and provide reallocation opportunities that gold cannot match. This isn't theoretical. The commercial real estate crisis is already visible in the data. Distressed sales are rising as lenders resolve problem loans. Office properties are showing stress levels near post-financial crisis highs. Regional and community banks have largely exited CRE lending due to excessive exposure and regulatory concerns. Refinancing challenges are creating a perfect storm. Debt service could rise 75 to 100%. For properties with sub-4% cap rate loans from the low-rate era, this is pushing cap rates higher and creating pricing gaps that are keeping transactions at historically low levels. The ripple effects are already spreading through the banking system. Regional banks hold over 40% of all commercial real estate loans in America. When those loans start defaulting at scale, when building values fall 50% below mortgage amounts, the banks have to recognize massive losses. Those losses eat through capital reserves that are already stretched thin from previous years of low interest rate lending. The Federal Reserve knows this. The Treasury knows this. They're not talking about it publicly because talking about bank failures can cause bank failures. But they're positioning behind the scenes. Emergency lending facilities are being expanded. Deposit insurance limits are being quietly discussed. Stress test requirements are being adjusted. These aren't random policy tweaks. These are preparations for systemic instability. And when systemic instability hits, when regional banks start failing in clusters, when commercial real estate values crater, when unemployment spikes because businesses can't get credit, the government response will be massive and immediate. Not because they want to print trillions of dollars, but because they have to. The alternative is economic collapse that makes 2008 look like a minor correction. This is where the framework becomes crucial because government response to financial crisis always follows the same pattern. First comes emergency liquidity. The Federal Reserve creates money to keep banks functioning. Then comes fiscal stimulus. Congress spends money to keep people employed. Then comes infrastructure investment. Government builds things to create jobs and economic activity. Each phase creates different investment opportunities, but the sophisticated play isn't trying to predict which phase happens when. The sophisticated play is owning assets that benefit from all phases simultaneously. Digital infrastructure benefits from emergency liquidity because data centers qualify as critical infrastructure for banking systems. It benefits from fiscal stimulus because government agencies need cloud computing services. It benefits from infrastructure investment because artificial intelligence requires massive computational resources. Healthcare real estate benefits from emergency liquidity because medical facilities provide essential services that can't be interrupted. It benefits from fiscal stimulus because government pays for Medicare and Medicaid. It benefits from infrastructure investment because aging demographics require new medical facilities regardless of economic conditions. Treasury inflation-protected securities benefit from all phases because each phase involves money creation that eventually shows up as inflation. The earlier you position in TIPS, the more inflation repricing you capture. This multi-phase positioning is something gold cannot replicate. Gold might rise during emergency liquidity as currency devaluation concerns increase, but gold doesn't generate cash flow during fiscal stimulus. Gold doesn't benefit from infrastructure investment. Gold provides single-phase protection in a multi-phase crisis. The timing advantage is even more significant. Gold typically doesn't rise until crisis is obvious to everyone. By the time headlines are screaming about economic collapse, by the time people are rushing to buy gold, the price has already moved. The framework components are moving now, before crisis is obvious. Data center REITs are rising because artificial intelligence demand is creating supply shortages today. Healthcare facilities are appreciating because demographic trends are driving medical demand regardless of economic conditions. You're not waiting for crisis confirmation. You're positioned before crisis arrives, capturing appreciation during the build-up phase, maintaining value during the crisis phase, and accelerating gains during the recovery phase. But execution requires understanding something most people miss about market psychology. Fear and greed don't operate on logical timelines. Markets can stay irrational longer than you can stay solvent. Positioning early means enduring periods when nothing happens. When your framework underperforms simple index funds, when everyone around you is making money in assets you've avoided, this psychological pressure destroys most sophisticated strategies before they pay off. The professionals solve this problem through systematic review processes that separate emotion from analysis. Monthly allocation reviews that ask specific questions. Are the underlying assumptions still valid? Has new information changed the probability of different scenarios? Are current positions still optimal given updated data? These reviews prevent panic selling during underperformance and prevent overconfidence during outperformance. They maintain discipline when markets are boring and maintain perspective when markets are terrifying. More importantly, they use scenario planning that prepares for multiple outcomes simultaneously. What happens if commercial real estate collapses faster than expected? Increase exposure to digital infrastructure and healthcare real estate. What happens if government response is larger than expected? Increase exposure to TIPS and sector rotation ETFs. Each scenario requires different tactical adjustments, but the core framework remains intact. You're not betting on one specific outcome. You're positioned for a range of outcomes with the ability to adjust emphasis based on which scenario develops. This flexibility is something gold cannot provide. Gold is a binary bet. Either crisis comes and gold rises, or crisis doesn't come and gold stagnates. There's no intermediate outcome. There's no cash flow generation. There's no reallocation opportunity. The framework provides options. Digital assets can be rebalanced between Bitcoin, Ethereum, and AI tokens based on which technology adoption accelerates fastest. Real estate can be shifted between data centers, healthcare facilities, and infrastructure based on which sectors show strongest fundamentals. This optionality becomes crucial during extended crisis periods, The 2008 financial crisis lasted 18 months from peak to trough. The recovery took another 3 years. That's 4.5 years of market stress and uncertainty. Gold rose during the initial crisis, then stagnated during the recovery. Framework components could be rebalanced continuously, capturing opportunities as they emerged across different phases. The next crisis will likely last longer and create more opportunities because the underlying structural changes are more fundamental. Remote work is permanently reducing demand for office space. Artificial intelligence is permanently increasing demand for computational resources. Demographics are permanently increasing demand for healthcare services. These aren't cyclical changes that revert during recovery. These are structural shifts that create permanent investment opportunities. Positioning for structural change requires different thinking than positioning for cyclical protection. The framework captures this redistribution. Gold simply preserves existing wealth without participating in wealth creation. But the real advantage becomes apparent during the recovery phase, when crisis ends and normal economic growth resumes. This is when most people sell their crisis protection and buy growth assets. This is when gold typically underperforms as fear subsides and risk appetite returns. This is when framework components accelerate because they're already positioned in the sectors that lead recovery. Data centers don't just maintain value during crisis. They become more valuable as companies accelerate digital transformation to reduce physical infrastructure costs. Healthcare facilities don't just preserve income during recession, they increase income as delayed medical procedures create pent-up demand. The framework doesn't just survive crisis, it profits from crisis resolution. And crisis resolution is where the biggest wealth creation opportunities emerge. Not during the crisis itself, when everyone is focused on protection, but afterward when foundation has been laid for the next expansion cycle. This is the difference between defensive positioning and strategic positioning. Defensive positioning tries to lose less during bad times. Strategic positioning tries to gain more during good times that follow bad times. Understanding this distinction becomes critical as we approach what could be the most significant market reset since the 1970s. Not just a correction or recession, but a fundamental restructuring of how economies operate, how businesses function, and how wealth gets created and distributed. Gold worked during previous resets because those resets followed historical patterns. Currency devaluation, inflation, flight to safety. The next reset will involve patterns that have never happened before. Digital transformation at unprecedented speed. Artificial intelligence displacing entire industries. Demographics creating labor shortages in essential services. These new patterns require new strategies. Not just adaptation of old strategies, but completely different approaches to risk management and opportunity capture. The framework represents this new approach. Not evolution of traditional thinking, but revolution toward future-focused positioning. The choice you make in the next 6 months will determine whether you preserve wealth or create generational wealth through the coming reset. Gold will protect some purchasing power, but the framework will multiply purchasing power. Gold will help you survive the crisis, but the framework will help you profit from the crisis. The smart money has already chosen. They're positioning for transformation, not just protection. They understand that the next crisis won't be like the last crisis. They understand that the assets that worked before won't work the same way again. They're not abandoning gold completely. They're reducing their reliance on it while building positions in assets that will benefit from the structural changes that crisis will accelerate. They're thinking beyond preservation toward creation. The question isn't whether the next crash will come. The mathematics guarantee it will. The question is whether you'll be positioned to profit from it or just survive it. Whether you'll follow the crowd into yesterday's solutions or follow the smart money into tomorrow's opportunities. The framework I've outlined isn't complicated, but it requires precision, timing, and allocation discipline that most individual investors lack. It requires understanding that the next crisis will be different from every crisis before it. And it requires positioning for that difference before it becomes obvious to everyone else. Because once it becomes obvious, once the headlines are screaming about commercial real estate collapse and regional bank failures, once people are rushing to buy whatever they think will protect them, the opportunity will be gone. The smart money is positioning now. The question is, will you follow them or will you follow the crowd?